Yeah, nice radio, soothing voice.
Right?
Yeah.
But let's just say that Jason does also look very good.
He does. Look what he's holding in his hand.
Ah, the Fairlife.
The Fairlife protein. Can't go wrong.
You can't go wrong with that. It is good stuff. It's the best chocolate milk you can get. Speaking of Fairlife, this is not sponsored by Fairlife.
Oh,
I
yes.
just want to say that. Throw that in there.
Yes.
Well, that's okay.
I forgot we're recording.
Yeah. We're up. Hey, what's up, everybody? This is the HIG podcast. Matty P here again with Bronson Kaufusi. What's up, Bronson?
Hey, everybody. How's it going?
How are you doing, man?
Just doing great. Great to be here today.
Hanging in there?
Oh, yeah. More than hanging in there. I'm loving life right now. It's great.
Oh, there's a lot to love.
Yeah.
Now, it's summer here in this present moment. I don't know, when people listen to this, it'll probably be many different seasons. But right now, it's blue skies.
Everything's green, too.
The
mountains are green here in Utah. It is beautiful. Trying to be outside as much as possible, fishing, golfing, hiking, all the fun stuff out here.
Oh, yeah. And I've got to say, our view from up here, we're at the Harris Financial Center here in Provo, Utah, up on the 7th floor, and our view is amazing. We look out the windows, we look east, and in any direction we look, we can see for miles and miles and miles.
It's true.
But just looking at the mountains, warm weather, seeing, the hikes that we could do, the rivers that we could fish, like what are we doing in here?
Making it happen.
Oh yeah. That's right. Again, this is not sponsored by Fairlife. This is sponsored by Bronson Shoes today, which they're dunks. I do know that, but I can't tell you much beyond that.
Yes.
No, we're excited to be here today. Excited to talk to you. We actually have a special guest who's going to be a regular here on this and everything else with Harris Investment Group. We have Jason Harris.
The man, the myth,
the man
legend.
And the myth. How did you meet Jason?
That's a good question. I met Jason, quite a long time ago. Maybe 6 years ago. And it was actually at a pizza barbecue. Yeah. At one of his houses. It was a cabin up the canyon. And I met him there.
Oh, wow.
Yeah.
Nice.
And it was incredible just meeting him and hearing more about what he was doing. And I was intrigued just because I was an NFL player and I was playing at the time, but wanted to be in real estate and was trying to find a person that I could invest with and who was willing to educate me and take the time. And I interviewed a lot of people. And when I started meeting with Jason, I was just blown away at how he could teach so simply something that seems so, it can seem very foreign and confusing.
A lot of moving parts.
And
oh, yeah.
So that's the first thing that really intrigued me about Jason and meeting him. And he was all game for teaching me and my wife. And it was great. It was great. That's how we met.
That's really cool, actually, and that reminds me of a story, something that I had written down earlier that actually ties in perfectly with that. We didn't really rehearse this intro at all, but like talking about passion, there was one day that I was working here with Jason, and it was a long day. We were filming. We had been filming pretty much all day. Wow, really, really long day, and filmed a few different segments for a few different avenues of communication, and we finally wrapped after the 13th hour of being here. So we'd been in the office for over 13 hours.
I like that. I
was tired, man. I was beat. Like, I got the SD cards out of the camera, out of the audio equipment, packed it up, and I was ready to just hit the bed. I was so tired. And I was walking out to our parking garage with Jason, and I realized that he was on fire. He had so much energy and passion, and I could feel his passion. I could see his passion, and he was excited because he had just spent the day sharing his wisdom, educating people, creating content that was going to help people. And so you mentioned when you first met him, that was an important factor of why you chose to work with him. And that night, more than any other night, it really opened my eyes to seeing that side of him. Right, and that's really what he does.
That's him.
That's Jason. And anybody who's met him will say the same thing.
It's true.
And he just has a great way of speaking about investing, real estate, because he's lived it.
Oh, that's why it's so exciting that we get to have him today.
Yeah, right? So let's bring him on. Jason, hey, welcome
to the show.
I do like this subject. This is a fun topic for me.
Yeah.
I was just surprised that your head's bigger than mine.
Don't try mine on. Man, we got Jason Harris now. Welcome to the show, Jason.
Thank you, Bronson. So good to be here.
Oh man, this is gonna be so great. We feel, so lucky to have you on here. I mean, you are the founding father of Harris Investment Group. So we're so excited. I mean, I just kind of want to dive right into it, honestly, because, man, a lot of people know, kind of the story of Harris Investment Group, where it started with you and how it's scaled into what it is today. And so today we're just going to spend some time talking about kind of what the focus is today with the firm and what's going on. So here at Harris Investment Group, we like to mix multifamily and truck stops, gas stations. And so the question for you is, why is that such a great combo?
Isn't it funny how few of our peer groups do that? It does definitely set us apart from many others who raise capital and deploy it into real estate. There's a lot to it. In the beginning, when I was in wealth management, I represented a few investor clients and families that owned and developed real estate. And through that process, I recognized how they were utilizing truck stops and gas stations as a tax depreciation loss play. They developed big multifamily housing, sold it for profits down the road once it was built and stable. And then they took these meaningful depreciation losses to offset the sale of their some of their developed projects that they sold outside of a 1031 exchange, and didn't pay any taxes on it. And I was blown away. And it's a triple net lease scenario versus a standard project in multifamily where you have several tenants. Where, in commercial, you may have one tenant or an anchor tenant. In a truck stop, you have your operator who's typically the leasee. And so anyhow, there's lots of different things to it. But the fact of the matter is there's some meaningful tax loss benefits that help us achieve bigger tax benefits for our investor base through the truck stop. There's immediate cash flow from day one, with annual escalators built into them. And so multifamily, flipping over to it for a second, typically we're buying distressed properties that are underperforming potential market conditions. And so what that means is the leases may be low for that market, the condition of the property may be poor, it's aged, it's tired, its community's got kind of a negative connotation to it. And so we want to come in and fix those problems to find its highest and best use by improving the property through better management and CapEx, adding some new amenities, covered parking, storage, exterior upgrades, interior, unit improvements. And then in that process, tenants are willing to pay more for a nicer place to live. And so we're able to go in and significantly improve the property. And that allows us to achieve higher rent rates, but that takes time, and often we're forcing vacancy in the beginning. So occupancy level drops, rental rate collections during that interim time go down, and we can't cash flow during that period most often. And so having truck stops that cash flow meaningfully day one while your multifamilies seeing some significant upside in the transition of the property down the road allows us to cash flow for our investors in the interim. And then once we hit stabilization on the multifamily by month 18 or month 24, depending on how big the property is, that way we can achieve some meaningful growth and appreciation and returns from the multifamily while the truck stops hopefully are paying some really nice cash flow. And so the blend of the two, there's better tax benefits, there's cash flow, there's meaningful growth and upside. And I think that's where we created a pretty good diversified portfolio, mixing those two together for our investors to benefit from all three of those profit centers.
Man, that's so great. Because, yeah, a lot of people, I mean, they want the growth, or they want the income, they want the cash flow, and they want the tax benefits.
They want it all.
They want it all.
We all want it all, don't we?
Yeah, and that's why. And honestly, I think that's why, you have structured it that way, and why Harris Investment Group runs that strategy, because it's so valuable to be able to do all of that. Seriously, I think that's like one of the greatest things that separates what we do at Harris Investment Group from our peers, just like you said.
Well, and we've looked at a lot of other asset classes too within real estate: storage units, RV parks, mobile home parks. The fact of the matter is, we have a really good track record in multifamily. We've built processes, we've built teams, we have a hybrid model between our property management and leasing that's in-house, while also leveraging some third-party people and companies. We have in-house crews where we've been able to keep our cost low during the turns of renovations of the multifamily side. And we have on-the-ground people in the markets in which we've invested, which helps us typically achieve a higher return potential than if we didn't have some of those things. And so we're dialed in with our multifamily as the operators. It's just the space that we know and do well in.
Yeah.
And we've built some really meaningful relationships with operators on the truck stop side, where we can go and find a no-name site, and if we can get it approved by corporate to put a better brand there, typically, recently it's been the TA centers. Mm-hmm. Well, now we can bring in a strong operator with a strong brand, and in time, create stability at that site with added revenue because of the restaurants that we're putting in. TA has a great reputation with truckers where they stop at a specific TA location. They have to park for the night. They're only allowed to drive for a certain amount of hours. And then there's all these amenities that they can shower, they can do their laundry, they can sleep and rest. There's a lounge for them, different places that they can eat. And so they're spending money. And all of that adds up to higher gross revenue at the store, which allows us to take a very tired site that's a no-name mon-pod type property and turn it into a high-functioning TA center brand with stronger revenue. And so when we go to sell the property, years down the road, we're now selling it as a stable TA center, which trades at a lower cap rate than a no-name site, with lesser revenue would. And so in that, we have good cash flow, an operator we trust, good upside on the growth, strong depreciation loss on the tax side, which is complementing well, the multifamily where we're the operators coming in and doing the work and the heavy lifting. And so the two together can work very well, and it's what we know and do. And so we've kind of stuck within our space that we, do a good job.
Yeah, man, that's so great. It makes me think about just kind of a theme that I've learned from you since I met you when it came to, because we did a multifamily deal, and Jason was so great just to keep me in the loop about what was going on. And in the off season, I would come and see him and ask questions and get on the phone with him and talk. And there's a theme from that moment that I met you to doing that deal to now being here at Harris Investment Group, and with the multifamily and the truck stops, it's control. And what do I mean by this? Multifamily, you have a lot of control. Before you go. And I think that's something that I've learned from you when it comes to real estate, is it's very powerful, because if you know before you go, because you have more control, then now you can move faster and you have more confidence. And so I feel like, with the multifamily space, that's exactly what I learned from you. And then in the truck stop space, it's actually the same thing. And so it's really amazing to have seen the growth that's taken place, from the time I met you to now, and how that has all, moved so quickly. But it comes from the confidence, from the control in all the different, assets that Harris Investment Group moves on.
When we first met, I was a financial advisor. I was running my practice at Edward Jones, and so I know other asset classes. I've helped people with their retirement planning and financial plans, stocks, bonds, mutual funds, annuities, those traditional asset classes. However, real estate has always been, where my passion is. Moreover, because I was in real estate before I even started as a wealth advisor, and I'd had success in my own real estate investing. And so my strategy of growing wealth was more in that of growing my real estate portfolio and then leveraging, retirement accounts as a diversification vehicle to my real estate that I felt like was really the avenue of where I was going to create more meaningful return, wealth, and tax benefits. And so with that, you talk about control. You look at mutual funds and stocks and bonds. How much control do we have on the outcome of those investments? Very little.
Not a lot.
There's ways that we can support the companies that we're investing in, but you buy an Apple product, how much is it really helping? You're not going to move the stock value any. And so for me, being able to analyze a property and then take it over and know that I can control its outcome more meaningfully, because adding a carport, I know what the costs are before I make the decision to put them in. I can even talk to the tenant base and ask them how much they'd be willing to pay if we added this amenity to them for them. And if I'm, getting $60 a month, let's say $30 a month, that's probably more market, and it cost me, say, $30,000 to build, and there's 20 tenants, well, 20 times 30, $600 times 12 is $7,200 annually. It cost me, what did I say, $30,000, $20,000? I'm making this up on the fly. Yeah. But then I can calculate what the return on investment looks like for that. And if it's a strong enough return, I'll move forward. If it's not, maybe storage units are a better use. And, you're talking to them about, do you need, added storage? And if there's a spot for it on the land, well, now you calculate, well, it's $50 a month they'll pay for storage, and it's still $20,000. And so you times that by the number of tenants. That's a stronger return on investment. So it makes it easier where you can control the outcome. Yeah. You can make the decision after you've done the research to know what your return looks like. And then where I'm not typically a long-term hold, I have owned real estate longer term, but more often I was younger and still relatively young. I want, higher IRR or growth in my investments. And so I'm looking to find the highest and best use of a property, maximize the income and return potential. Once I've achieved that, I may look to take the profits that I hopefully made through that improvement and reposition it into something new that has similar upside opportunity that the former property did before I came in and fixed it and improved it and made it better. And so through that, we've been able to make some very strong returns, especially when the markets have been stronger, where more recently, the last couple of years, we've had more headwinds with interest rates and property taxes and insurance that have increased significantly across the country in all markets, really. And so, but even still, when you're improving return and gross revenues significantly, you're able to either cash flow more if you're keeping it for the long run because of that increased income, or sell and have a meaningful profit, hopefully, that you can then redeploy utilizing a 1031 exchange in most cases, so you're deferring the tax liability, because taxes are our biggest expense in America. And so the more we can defer or eliminate the tax burden, the stronger the returns that we're actually making and achieving over time.
Wow, I love it. So let's dive into one of these TA station deals right now, the White Hills TA Center conversion. Just maybe you could talk about it. Did it meet expectations? What do you love about that deal? Yeah, I would love to hear your thoughts.
Yeah, so TA Center, it's just outside of Vegas, that particular deal. We bought it in 2021, which you could argue was closer to the height of the market, right? Uh-huh. And so if the market conditions had been more favorable, I think that that significantly helps cap rates and values. but we've had that work against us. So, we're sitting here today in 2024. TA Center, White Hills specifically, has cash flowed nicely for us since day one. I don't know where it's at the moment, but I think we're somewhere around a 7 or 8% cash on cash return. Wow. So had you invested $100,000, you'd be making $7,000 or $8,000 a year of cash flow. Yeah. $1 million would be $70,000 to $80,000 a year of cash flow. That particular year, we had to have $1 million investment for anyone that was doing a tick position on it, or in the fund. With that, strong cash flow, that's gone well. Trying to sell what we purchased it at was a 6.5 cap rate in a market where cap rates have expanded and values have declined is rather difficult. Now, with that being said, there's some unique opportunities with truck stops and gas stations that perhaps isn't the same for other asset classes. And let me explain. Now. Yeah, currently well, right no, and maybe in any given period.
Oh, okay.
So operators have done very well in the gas station or in the oil and gas industry. Mm-hmm. Profit margins have been strong on their fuel cells over the last few years. And because of that significant profit, as operators, you want to expand your operations into more stores or current stores that you're looking also for new opportunities to increase revenue. And so, often these operators will partner with investors like us who are willing to perhaps put up our own money to buy the land, the property, the equipment, and, the store, so that the operators themselves can invest in the actual operations of that store and continue to expand, managing and operating more stores. And so in that process, TA Center White Hills, the operators have absolutely crushed it. Now,
Tell us more about that. Yeah, crushed it.
That's a great thing for owning it as an investor. Mm-hmm. However, we don't participate in all that upside. Right? Mm-hmm. We have a triple net lease arrangement for 20 years locked in for this asset where we get a 3% annual escalator. And so, I don't have the numbers in front of me, but let's just say the initial lease started at $2 million a year. The next year it'd be $2,060,000. The year after that it'd be $2,124,000, whatever the number is, but it's a compounding 3% amount. Mm-hmm. The good news is, as that operator's crushing it, that means they have the ability to pay us the lease without any problems because their profit, their net income is very strong. Their net operating incomes are very strong. Now, that doesn't help, however. It does some, but it doesn't help us a lot when we go to sell the position, which we're now looking to do with the TA Center White Hills property, because the new buyer that would be assessing and looking at the deal, they're saying, okay, we've got a great operator here. There's strong profit margin. The EBITDA is 3 to 1 or more. I love that because, again, it means that they're going to be able to pay their lease with ease because the property itself has such strong profitability. So that's a good thing. It's good for the lending and for the financing. However, Bronson, unfortunately, interest rates are almost double as to what they were in 2021. And so the new buyer has to go and get debt at 7.5% interest rates, where we were able to get it, say, at 4% or less. Yeah. And so that's a really difficult thing for a buyer to come in and purchase the asset for a larger amount than what we were willing to pay with cheaper debt in 2021. However, here is something that's really awesome. Because the operator has done so well at this particular site, and actually this operator's done well at all the sites that we've purchased with them. I think we have 4 positions with them now. They are interested in buying the store back from us.
Interesting.
At a higher price than what we purchased it at. Because the way they analyze and view the deal is different than, say, an investor like you and I would. We're only able to look at the lease rate, which is our cash flow, and analyzing what we'd be willing to pay versus what we'd have to borrow in today's interest rate market. And that cash flow is going to be what decides for us what we would be willing to pay.
Yeah.
The operator, however, looks at it and says, let's just say, netting $6 million a year at this store, and I'm only paying HIG or Harris Investment Group $2,060,000 a year on the lease, I've got a lot of profit, almost $4 million, and I still see some upside. I can buy this store from them for, let's say, $2-3 million more than what they bought it for a few years ago. Turn around to TA Corporate and say, I've got a $6 million a year store with big upside still. I want to change the lease rate from $2,060,000 to $3 million. And if they get that approved, they can buy the store from us for $3 million more, turn around and increase the lease, which we can't do because we're locked in for 20 years, at a $3 million a year amount, and take it to the market. And even if cap rates have expanded, because the lease and cash flow is now $3 million a year with still healthy coverage from the operators, they could sell it for a $6 million quick profit from us. And so they'll buy it for $3 more, go sell it for $9, and make the $6 million difference. And so we're actually working on a buyback right now from the operators on the TA. Now, again, that was not planned for. It's not something that we have to have happen in order for us to sell these. But when it happens, and if it happens, it can be a very big opportunity where we're able to then, and this is what we're looking to do, is repurpose the initial investment, that now the $3 million of increased equity, that's the growth, the appreciation, plus the cash flow that we've been able to achieve along the way, which has actually been distributed to investors. But assuming it hadn't, and redeploy that now into a new market, because we're in a different market now than we were in 21, where we're buying these stations at 10 cap rates, or sometimes even a little higher. And what that means, Bronson, we can go and repurpose this money in a much higher cap rate, with debt at 7.5%, still cash flow 6 to 10% cash on cash annually. But guess what? If market changes where interest rates improve over the next few years, we have a 10 cap rate investment that's going to continue to increase because of that annual escalator, and we could refinance at 5% money down the road, or sell it to a buyer who can borrow at 5% money and be able to capitalize on cap rate compression, which is more likely to happen if interest rates go down, because typically there's a form of correlation between interest rates and cap rates. If interest rates go up, cap rates may go up too. Not always at tandem, but they will move in the same directions more often. And so it's an awesome opportunity, Bronson, where we can sell, not pay taxes, utilize a 1031 vehicle, repurpose into a 10 cap rate or better deal with operators we trust, have proven themselves to do well, and go and have the same value add approach on our truck stop stores, cash flow along the way, and know that most likely, even if cap rate or if interest rates don't improve, we know that the operators coming in to improve the gross revenues of the property like they did on White Hills. And that will strengthen, the potential that a new buyer would be willing to pay for it, especially when we're doing a no-name site at 10. Once it's a TA center, TA centers trade typically, even in today's market, at a 7 to 8% cap rate. So you get that compression along with interest rate compression. We may see some very big returns, over the next few years because of these operators who are willing to give up more upside than they were in 2021.
Yeah, wow. That's incredible.
I hope that made sense. That was probably a little bit more detail. But
it's great.
It's an exciting time right now to be looking at these deals.
It is. And I think that's something that I think is, so important for, everyone that's listening to learn about, because when someone starts talking about, something that you don't know in the different asset classes. I mean, for me, when I start hearing people talk about something I don't know about, it's like, I want to go learn about it. And the first time maybe I don't know it, but then I'm gonna go look it up and then keep learning. So man, okay. So right now is, I hear you kind of messaging it right now, but like, what's the most impressive investment opportunity? Because we're looking at these truck stops and multifamily. I mean, what do you feel like is the most impressive opportunity in kind of our, neck of the woods and kind of what we look at?
We've analyzed a lot of deals. Matt's getting calls.
He's our CIO.
Yeah, Matt Denning, our CIO, he's getting calls hourly by brokers in several markets. There's distressed opportunities that are happening. However, there is still very much a disconnect where sellers believe that their properties are worth versus what maybe the market, is willing to pay. And so surprisingly, even hundreds of deals that we've looked at, our multifamily project opportunities, we're having a hard time finding ones that pencil at 20% IRRs or better. And it's just the debt market that's making it more difficult.
Yeah.
You've got property taxes that are up, insurance costs that are up, utilities that are up, and inflation's up in general. And so with interest rates also being high, even though there's stress in the market, the distressed state's still not strong enough in order for us to justify and deploy capital into many opportunities. Now, we do have an exception. We have this deal, in St. Louis that we bought from the bank who was going to foreclose on the sponsor group. Mm-hmm. And because of the ability to negotiate with the bank, who either had to choose foreclosure or bring in another capital partner and sponsor group like us that has a track record of success in this, it made it easier for us to get better terms from that group. And they were the ones that actually lent us the money at preferred terms where we had no fees, meaning no loan origination charges, higher leverage, 18-month term versus they're typically a 12-month or shorter term. And it was more of a management play than it was a CapEx need. And, we have a really good management team that we work with in student housing that was the fifth management group that the previous group finally hired, which had they used them initially, I think it would have been it would have been a lot better for them, I believe. So with that being said, we're really excited about it. It does pencil above our 20% IRR threshold. And quite honestly, if we're able to get the occupancy up by the next school semester in the fall, we could turn this position around in a year and a half and see a very strong double-digit return, very, very strong. So we're excited about it. However, on the most part, we're having a hard time finding multifamily deals that can beat the truck stop conversion opportunities. We've talked about tax benefits. They're meaningfully higher because of the oil and gas component of a truck stop than that of multifamily. Mm-hmm. So because of the phase out that's taking place from the 2017 Tax Cut and Jobs Act, this year in 2024, you only can get 60% bonus. Last year it was 80, and up until 2022, it was 100%. Mm-hmm. Well, we're still aiming for a 1-to-1 ratio of depreciation loss to equity. And almost all the peer groups, that I've seen operating memorandums or their fund objectives, they're seeing a much smaller depreciation loss pass through that they're able to share with their investors. 1-to-1 means if you invest $100,000, you can get $100,000 depreciation loss on your K1 in the first year. The only way we're able to hit that high of an amount is because of the truck stops that we're incorporating along with the multifamily. But for the first time, the truck stops aren't a drag to the IRR.
Wow, that's huge.
It's the first time that we're looking at these deals and saying there is more upside opportunity and return on our truck stops than that of our multifamily. They deliver stronger tax benefits. They deliver cash flow year one, day one even, with annual escalators built in so the cash flow improves. And for the first time, meaningful growth, meaningful appreciation in a market where we do believe rates are likely to be lower in a few years than they are today.
Wow, that's a very unique time then, right now, and literally today.
And we can't impact that. It'll be favorable for the multifamily side as well if interest rates go down.
Yeah.
But what we can do and what we do have control over is bringing in a good, strong operator, finding a site that has a lot of traffic and truck volume passing through, and if we can get it approved to rebrand to a stronger brand, we can achieve cap rate compression. If we achieve that, we can achieve higher value at the property. And so that's our goal and our strategy right now is, can we identify some good opportunities with operators that we've trusted and have proven themselves, where we take a mom-and-pop operator or site and rebrand it to a stronger brand. And in that process, over the few years, that's the value add creation. We are going to significantly improve the revenue of the site by making a stronger brand and using their affiliate relationships, improving the technology at the pump so we can have a lot more gas sales at the pump. We can improve the convenience store, the restaurants, the bays, the parking lots, and all the other amenities that truckers are willing to pay for. And in that process, when we go to sell it, now we're selling a stable, cash-flowing machine, is the hope, with a strong operator, where we now can achieve a 7 or 8 cap rate in today's market, and maybe better if interest rates, go in our favor.
Wow. What an incredible opportunity.
It's awesome, Bronson.
Right now.
No joke. It is something that, in all the years that we've been assessing deals, we've never seen strong return in the truck stop space. It's mostly more a cash flow play with some good tax benefits and, a small double-digit type IRR, know. And right now, we are seeing things that the IRRs are strong enough where we just put it at 20, even though in our models we can see 30, 40% type IRRs over a 3 to 4 year period.
Wow, that's incredible. And that's why it makes sense that we mix them within our funds, just like right now what we're doing with Fund 3. So
well, yeah, absolutely. And this is the first year that we're offering, a different share class. So we have an income share class and a growth share class within the fund. Some of our investors really are seeking income that they'd like to maximize for, where the truck stops deliver that immediately.
Yeah.
Others want maximum growth, which the truck stops actually still deliver on.
Yeah.
But the multifamily value add is going to help us achieve that as well.
Yeah.
And so you can choose all growth, all income, or a mixture thereof. And so, we're aiming to hit a 6% cash on cash return for our income share investors. We can deliver that now where we couldn't before because of the truck stops that are able to deliver the strong cash flow.
Yeah.
While our multifamilies, are suffering in the cash flow space because
tied up
purposely, because we're trying to renovate and improve, and we decrease the occupancy levels during that time. But at 18 months to 2 years, those assets should be stable at that point with much higher rent rates and other profit centers and income that we're able to generate from the property. And so at that point, cash flow will significantly increase for the multifamily positions, allowing for stronger, cash flow in the fund. And then, growth and return, which is what we'll look to do, come year 3 into year 4. Sell these positions and hopefully capitalize on the value creation that we've achieved both on the truck stop and the multifamily, and still give some very good tax benefits between the two using the cost segregation studies. And then, that report allows us to pass through on to the K1 to the investor, the depreciation loss achieved.
Wow. Well, we got some exciting things going on right now at Harris Investment Group, and we're just so grateful that you were willing to jump on today with us and talk more about, the different strategies about Fund 3 that's going on right now. Man, it's just so exciting. So, thank you so much.
Thank you, Bronson. No, absolutely. Yeah, it's a tougher market. A lot of asset classes are not performing as well. We have some that are, but if you're looking at the next few years and where to best position your capital or investments, there's a strong case for truck stops and hard assets in real estate. They've been hurt some over the last couple years, and looking out, over the next few, I think that we're going to see some really exciting opportunities in return.
Wow. Well, we're excited to, continue to do this podcast and talk about that journey and what's going on. So stay tuned for next week.
Thanks for having me, Bronson. Yeah, appreciate it.
Well, everyone, thanks so much for listening, and we love having questions from our audience. So if you have any questions, just send us an email at contact@harrisinvestmentgroup.com, and in the subject line, put down HIG podcast, and we'll answer them. So we're looking forward to getting those questions. Bueno.
Awesome.
Say man, me eyes them blaze now. Journey through celestial ways.